Saturday, June 29th, 2019, Maneco 64, home of alternative economics and contrarian views. Today I want to talk about the US economy. I want to talk about the Dow Gold ratio and gold. I want to talk about gold futures, the commitment of traders report, and what it might be telling about the bullion banks, or the commercials as they're called. I also want to go briefly over an article that I saw that I recommend you read. It's on a website called wallstreetonparade.com. I also want to look at a headline I saw, which kind of, made me think, there's something definitely wrong here with the stock market, with the economy, with all the indicators like the yield curve. There's definitely something that's going on that we're not being told, that I think the powers that be, the central bankers, people at the Treasury, IMF, World Bank, they know that there's something wrong. But of course, they're not going to tell the public to take cover. They're going to keep encouraging people to buy into the stock market, as they usually do. So let's start with the headline, and then we segue into the US economy, right? It says here, it was like yesterday I was looking through investing.com, and I took a snapshot, and it says Wall Street set for best June in decades as G20 convenes. So, and then I saw another article saying that it was the best June in like 80 years or something. And what really got me kind of thinking is that here we are, the stock market doing really well, near all-time highs. And, the Federal Reserve now is probably going to cut rates again for the first time in years in July. While late last year, Goldman Sachs and the whole market was expecting 2 to 3 rate hikes this year. They were expecting the Fed to keep doing the QT, which is the inverse of money printing, or QE, unwinding their balance sheet. But now everything is turned 180 degrees. And it's kind of almost they're juggling things, trying to tell the public, oh no, everything's fine, the economy is great, keep an eye on the stock market, it's going higher, while on the other side, we look under the hood, or the bonnet as the English call it, and we see that the engine is completely breaking down, that there's not enough water, it's heating up, right? So that's why I want to look now at the economic indicators that came out in the US. And it's from investing.com. They have a very good economic calendar. They publish everything for all the countries in the world. I've got here US and, basically the G7 countries. So let's start from, Monday last week, or this week still, 24th of June. So we had the Dallas Fed Manufacturing Business Index. Not a very important number, but still significant. It was expected minus 1.0, and it came out minus 12.1. So that was downside surprise there for that number. So we go on to Tuesday, and we have the house price index, which is actually a little stronger, 0.4 versus 0.2. But then the number that caught my attention on Tuesday was the Conference Board Consumer Confidence, as you can see here, CB Consumer Confidence. That came out at 121.5, and it dropped from 131.3, the previous number, and it was a lot lower than expected. It was expected at 131.1. And why do I think that indicator or statistic is important? Well, as many of you might know, the US economy is made up of, the GDP. 70% of the GDP is consumer spending. So if the consumer starts losing confidence, it could be very detrimental to the economy, being that it's 70% of GDP, right? So that really caught my attention. That's showing me that the economy is unraveling very quickly. Of course, 1 month number doesn't a trend make. We need to see, the next month, see if that keeps dropping or rebounds. And then you get new home sales came out the same day. That was also a lot lower than expected. It was expected at 680,000 on an annual basis. Came out at 626. It was a drop of 7.8%. Market was expecting a rise of 1.9. So another surprise on the downside. Then you've got Richmond Fed Manufacturing Index, or Richmond Manufacturing Index. That was at 3. Was forecast 7. Another downside surprise there for that number. So let's go on to Wednesday and see what we got. Well, we've got durable goods orders. Was expected unchanged for May, and it dropped 1.3%. They've got other durable goods numbers like core numbers, but I want to look at the headline. So that was also worse than expected. Another negative sign. Also, the goods trade balance there, minus 74.5 billion. It was expected minus 71 billion. How is that negative? Well, that means that the U.S. is running more and more of a bigger deficit. That, that also eats into the GDP number. So Thursday, jobless claims. Jobless claims is another important weekly number. That was expected at 220,000, and it was higher at 227,000. GDP, that was a final number. That number has been, around for a few months. So that wasn't really important. It came out in line, 3.1%. And that's also looking in the wing mirror, right? It's like in the past, the first quarter. Friday. So what did we get yesterday that was important for the U.S. economy? Well, we got the deflator data. They came out in line, PC deflator, which I think doesn't really reflect how fast prices are rising. But most importantly, yesterday was the Chicago PMI, or the Purchasing Managers Index. It is a survey. Any number above 50 means that there's an expansion in the Purchasing Managers Index survey, that the sector is expanding. The Chicago PMI is a regional number, but I can tell you that it's very important for the markets, is a bellwether for the markets, aside, from the national PMI. That's a big drop. The previous number was comfortably above 50 at 54.2, and it's dropped to 49.7, which means it's a contraction. Another sign that the economy, there's something that's starting to turn sour for the economy, I would say. We had Michigan, University of Michigan data. So we had the consumer expectations, expected 89.4, came out 89.3. So, and consumer sentiment was a little stronger, 98.2 versus 98. So all in all, as you can see, most of the numbers last week were worse than expected. And the one that I think is really important is the Conference Board consumer confidence that dropped quite drastically last week. So this is showing me that, the yield curve, the fact that it started inverting a few months ago, has been right. And I think that the U.S. economy is about to slow down quite abruptly. And that's probably why the Federal Reserve is talking about interest rates. And I think it's very dangerous at the moment to be in the stock market. Am I advising people to get out? No. We could very well blow through the all-time highs. Who knows? So with that, let's quickly look at this article that I thought was really interesting on wallstreetonparade.com. It's entitled, "Today's Wall Street Has All the Hallmarks of Tulip Mania," by Pan Martins and Russ Martins. I'll put a link to this article below in the description. I highly recommend it. I think it's a good read. It's just, let's see what they say though at the end. And this is what is quite interesting, that it shows, you know, the big distraction that the Dow is, and the fact that, you know, President Trump, and I'm not like judging him or anything, I'm just stating the facts. He keeps playing, you know, cheerleading for the stock market. A stock market that he thought was a bubble back in 2016. Now he thinks, you know, it should be 5 to 10,000 higher, even though we're about 9,000 points higher than when he said it was a bubble. But they say here, and I quote, "The average American is too busy working long hours and trying to rebuild the savings they lost in 2007-2009 Wall Street financial crash to pay any attention to the corrupt market bubble that continues to inflate. The young people of the nation are too busy trying to pay off their $1.5 trillion in student debt they took on to attend college in the richest country in the world to understand any granular details of what is going on in the markets." And while all of this is happening, what is the Wall Street Oversight Committee in the US Senate holding hearings on? This month it looked at the threat coming from China, completely incapable of seeing the growing threat from an out-of-control Wall Street. So it's a great article. I recommend it. Let's see some of the headlines over the weekend. And I think we need to focus under the hood, as I said. Look at what the economy is doing. Look at the fact that the yield curve is still inverted. Look at the fact that bond yields are collapsing. You know, the 10-year yield was 3.25 last year. It topped there, and now it's at 2%. That's not a sign of a strong economy. So whatever we hear from, you know, the G20 about the China trade, we need to put that a little bit to the back of our minds. Yes, it might impact the market in the short term, but things are not well with the economy. So yeah, Zero Hedge is saying ceasefire, US-China trade talks back on track after Trump concedes on Huawei. So now let's look at the gold market. Let's look at the Dow gold ratio and what it means. So let's start with the gold futures on COMEX, or the paper market as it's called. Yes, I worked as a futures and options broker for 20 years in the city of London. I was a broker for institutional clients. What does that mean? Well, my clients were actually banks, fund managers, corporate treasuries, institutional investors in general, right? Even though the core of my business was in the bond market, I did trade gold and silver futures for clients once in a while. And I can tell you that even though the gold and silver contract on COMEX are deliverable, no one hardly ever takes delivery. So it is a paper market for all intents and purposes. So the CFTC reports every Friday at 3 p.m. New York, the Commitment of Traders report. This Friday, yesterday, they reported, and this report is the positions as of Tuesday this week, so from the 25th. And I've been looking at this Commitment of Traders report, and the commercials, which are basically the bullion banks, you know, the JP Morgans of this world, the Barclays, the Goldmans, the UBSs of this world, all the big to fail banks, you know, the bullion banks that help, you know, the central bankers manipulate and control the paper price or the price of gold. They're usually short, right? So they've been increasing their short positions the last few weeks, and I've noticed that. And you can see here that they've increased it by 54,500 in the latest report. Their long positions increased by 18,235. So net, they increased their shorts by 36,000. And you can see they're massively short here, 420,378 contracts versus only 160,228 long. So each gold future contract, by the way, is 100 troy ounces, but that's just like fictional, of course. But usually, with the short positions by the commercials increasing so much like that, usually it's a sign that the markets are going to turn and go down. Gold has been going up the last few weeks. We broke through that 1375 level, and gold just took off. But it could also mean that they're having a tougher time, the commercials or the bullion banks, controlling the price of gold. And what could that mean? Why would that be? Well, it could be that the physical market, where real gold changes hands, is taking control of the price. Physical market, of course, LBMA in London is a physical market, half and half, a hybrid. It's still very much of a paper market, but it's much more physical than COMEX. And then you have to go to the Far East and Shanghai, Shanghai Gold Exchange. That is purely a physical market. So maybe things there are hitting up. Maybe demand for physical is increasing. So that's something that we're going to have to keep an eye on the next week or two or a few weeks. Here's the gold chart, a monthly chart. And I would point out, as you can see here, gold, this is the highest monthly close since April 2013, so 74 months. So we've had a significant breakout. Will the commercials be able to turn this market around and maybe make the market, the price go back to that 1375 level? I know some people think the key level was 1350. I personally think it was 1375. It is possible that we could retest that level, and it's not necessarily a bad thing. A lot of times, be it on the upside or on the downside, when markets break key levels, they usually turn around to retest that breakout level, be it on the upside or on the downside. And after the retest, they go straight back up or straight back down, depending which way it broke. So we need to be patient. Of course, for traders, it's different. I still recommend stacking, of course. It's a way of saving. Physical gold and silver. Trading is a different story. So with that, let's have a look at the Dow gold ratio. So what is that exactly? Well, it's basically a measure of how many ounces of gold you need to buy one Dow Jones index. So that's simply what it is. And why do I think it's important? Well, because if you go back to before 1933, people didn't trade gold as they do now because there was no gold future. Gold was money. $20.67 was 1 ounce of gold, and it didn't change. So the Dow was priced in gold back then. If you extrapolate back. I've had a look at the Dow gold ratio over the last few days, and I've got a couple of charts here. The first chart is a long-term chart going back just over 20 years, and you can see that at the dot-com bubble top in 2000, the Dow was around 11,700, I think, the top, and that ratio got up to I think mid 40s or 43 thereabouts. Can't really see very well here on the chart, but yeah, gold at the time bottom around $252 an ounce, and you can see that gold outperformed the Dow all the way, that first decade basically of this century up until September 2011. The ratio dropped to under 7.5, so you only needed 7.5 ounces of gold to buy one Dow. That was when gold went to $1920. And ever since we've had the correction in gold and this range trading that we've had for the last few years, the Dow has outperformed gold. Paper assets have outperformed. Why is that? Well, I think it's thanks to the central banks and the governments of the West. They threw everything at the banks, at the financial system, the paper market. You know, they did QE, zero interest rate, negative interest rates. So it's no wonder that gold did not outperform the Dow. But as you can see now, it looks like we're forming a top here. And it looks like the top was back in 2018 at 22.5. So with that, let's look at a shorter term chart. And you can see here that it's a clear head and shoulder formation. And the left shoulder started forming at the top of the stock market early last year. And it's kind of followed the tops in the stock market that we've had. I know the NASDAQ and the S&P have made new highs, but they haven't really broken out totally. So yeah, this is showing me that the markets are making a massive head and shoulder top versus gold. Does that mean that the markets, the Dow and Federal Reserve notes, can't keep going up? No, but what this is showing me is that gold in Federal Reserve notes will probably start going up faster than the stock market. It could be a combination of a weaker market, stronger gold, or stronger market, or even stronger gold. This is showing me that paper assets are could start underperforming. So I think it's important that we keep an eye on this Dow gold ratio. So I was speaking earlier about stacking, about the COMEX, that they trade paper. So I designed a shirt yesterday, and I took a photo of this Rothschild, gold bar that I have, and it's quite rare. And you can see the shirt says, keep stacking and take control of your money supply, right? So it's a little bit of a play on words on Amschel Meyer's Rothschild quote in the 19th century when he said, give me control of the money supply and I care not who makes the laws. So sometimes we gotta, take advice or learn from, these people. Doesn't mean to say we have to act like they do in all aspects of our lives, but in this monetary environment, I think it's more important than ever to keep stacking, and it's a bit of fun. It's in my Teespring store. There's a link below in the description to the Teespring store, maneco 64. I have connected my Teespring store to YouTube. I'm not sure as you watch this video if all my merchandise is now showing, below the video. If not, you just click on the link to my store if you're interested. It's just a bit of fun. It's a nice gold bar. It's a rare one, very difficult to find. I've had it for many years. So there you go. US economy looking under the hood doesn't look very good. Try to ignore all the noise about trade, China, US. Focus on the yield curve, I think. Focus on the fact that, the yields are very low, and that's not a good sign for the economy. Yeah, and keep stacking. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet, and you can also follow me on Twitter, Steemit, and on DTube. I wish you all a great weekend. Take care. Bye.